Thank you very much. It's a pleasure to be here. Second time that I'm here in this conference. Last time was, I think, around 12 years ago when it was not yet the Swedish House of Finance, but CIFR. So it's good to be back. And I will talk about the theme of learning from market prices. Which is something that I've been working on over the years, a key theme in my research. And this is the general outline that I would like to follow today in the 40 minutes or so that I have. So I'm going to start talking about generally why we think there is information in prices. And why it could potentially be useful to try to learn from information in prices. Then I will go more specifically into the idea that managers could learn from stock prices of their own firms or their competitors. And I will show you some of the research that has been done on this, empirical research in particular. I will then expand more broadly and tell you that it's really not just about managers learning from prices, but it's also other decision makers. And I will discuss a bit more broadly which other decision makers could be learning from financial markets. And I will also say that, you know, it's not really just stock prices. It could also be more general than that, commodity prices and so on. And I will discuss this a little bit. Towards the end, I will argue that the fact that there is learning from market prices by decision makers in the real side of the economy basically suggests that we may want to think about a new paradigm when we analyze financial markets. Traditional paradigms basically looked at one-way flow, where people in the financial market are trying to figure out what is going on in the real side of the economy. But now that we incorporate the two, there will be two-way flow. People in the financial market will try to figure out what is going on in the real side of the economy, but people in the real side of the economy will also learn something from the market. And this introduces a feedback loop that provides some interesting results on what could be equilibrium outcomes in financial markets. And I will discuss this generally. If we have time at the end, I will give you some examples for some of the conceptual insights that I and others have developed along these lines to help us understand better what we should expect will happen in equilibrium between the financial market and the real side. Okay, so that's generally what I would like to talk about. So let me start by giving a broad motivation for the idea that there is useful information in financial market prices. I think this is really a basic premise of financial economics, that market prices will be very informative about the fundamentals of underlying assets. If you want to track it back, this line of thinking goes back to Hayek, 1945, where he basically argued that prices will be key sources of information for guiding production and allocation decisions. Okay, and it's not that difficult to understand that because at the end of the day, prices aggregate information for many different traders who are collecting information, producing information, trading on this information for their own profit motives. And at the end of the day, this information will be reflected one way or another in financial market prices. Okay. Hayek was referring more generally, not just to financial market prices, but he argued that if you look at the prices of goods and services in the economy, this will be a very powerful, even the most powerful source of information you can find. But his arguments apply more broadly than just to goods and services and easily extend to stock prices and financial market prices more generally. Now, over the years, there has been a lot of empirical research in financial economics. There is a lot of debate on how informative prices are. Some people will tell you prices are complete noise. Others, I think, believe that there is useful information in prices. I think at the end of the day, as you will see as I go along with my talk, the truth is a bit of a mix of the two. I think there is certainly noise in prices, but it's also hard to argue with the idea that there is also information in them. One of the leading examples that is often mentioned as empirical study that was very important for delivering the idea that there is information in financial markets is a paper by Roll from 1984, where he analyzes prices of orange juice futures. And he basically shows that when you look at these prices, you can actually improve the forecast of weather on top of what meteorological forecasts are doing. Okay, so basically the idea is that there are people there who trade, they have their own insights, their own models, their own pieces of information and opinion, and when you aggregate all these together, you can get a useful signal that does much better, or at least improves upon what professionals can do. More broadly, there is a very large literature in economics that argues that prediction markets should be developed and taken very seriously as a source of information in economics, in politics, and more generally. Okay, I mentioned here a study by a survey by Wolfers and Zizovich, but this is a large literature. And basically, this literature has shown that if you're looking for sources of information, market prices can do a better job than many other ways to get information out of the public. So for example, if you try to compare prices to polls, you will get more precise predictions out of prices than out of polls. Okay. So they argue, we can use that for elections, for many other things that policymakers want to do. And in general, there are challenges, and I will discuss some of them later on. But this is something certainly that is taken very seriously. So when you take this basic premise and you think about it in the context of financial markets, I would argue there is an important feedback effect that we may want to think about when we think about financial markets. Given that there is information content in market prices, it is natural to expect that decision makers in the real side of the economy will take this very seriously when they make decisions. Okay, so every decision maker, when they make decisions, they are looking for multiple sources of information. They have the information they produced internally, they have their own opinions, but market prices will be another source of information that they should look at. And again, what I will argue later today is that there are different prices that could be useful. You can think about stock prices, futures prices, bond prices. You can think about your own stock price, or you can think about the stock price of your competitor. It depends really on the context and on the purpose. And there are many decision makers that could potentially learn from prices, as I will argue. I will start by focusing on managers, but then I will broaden the scope and say you can think about creditors and regulators, and more generally than that. Anyone who is looking to make a decision could potentially gain some information from market prices. Now, one pushback, especially in the context of managers, is why should managers learn from the prices of their own stocks? Otherwise, we usually tend to think, managers know best about their own stock. And I'm not going to dispute that. Managers probably have the most precise information about their own firms, more than any outsider. However, what is important to emphasize here, and this is something that I will spend more time on, is that I do not say that managers have less information than some investor outside. What is important here is that there is some information in the price that managers did not know, did not fully appreciate before, and I will come back with examples later on, okay? So let me now talk about managerial learning from stock prices, which I think has been the main application in the academic literature for this idea of learning from prices. And I will discuss what managers could learn from prices and some of the empirical evidence that we have that they are potentially learning from prices. And then I will discuss more broadly other decision makers who could be learning from prices. Okay, so should managers learn from stock prices? Here is an old quote from Fama and Miller, two legends in academic finance, from 1972, where they argue that an efficient market has a very desirable feature. In particular, at any point in time, market prices of securities provide accurate signals for resource allocation. Firms can make production, investment decisions, and so on. Okay, so they basically acknowledged it upfront that we should expect production investment decisions to be based on prices, and this is why we care that prices will be efficient. So again, if financial markets aggregate information from many different market participants, this information can help managers in their own decisions. And as I mentioned before, it is natural to think that managers know many aspects of the firm best. However, there are still dimensions on which they can gain from others' insights, okay? And these are mostly the dimensions that require more forward-looking assessments, soft information, understanding better strategic considerations, and so on. So for example, I would not expect managers to try to learn something about the technology of their firm from financial markets because they probably have better access to this information than anyone outside. However, if you think about trying to understand whether there will be much demand in the product market for what they are trying to develop, this is something on which outsiders will have opinions on and managers could potentially gain from it. If you think about synergies in mergers and acquisitions, and I'm going to go through two particular examples where I think this was key. But think about a merger, an acquisition. Usually when you make a decision on an acquisition, you have some model that basically tries to forecast future synergies between two firms. And there is a lot of assessment and soft information and opinions that go into it. And clearly, managers could potentially benefit from what is the general public view on it beyond their own model, the model that they developed internally. Similarly, you can think about strategic interactions between firms in the market. Again, outsiders may have opinion on who is going to win a competition across competitors, who is going to take over the market. Those are things that managers could also potentially learn about. Okay, so let me consider here two examples. Well-known acquisition attempts that happened about a couple decades ago in the US to sort of understand the dynamics of how this may play out. One is Coca-Cola and Quaker Oats. In 2000, November 20, 2000, Wall Street Journal reports that Coca-Cola was in talks to acquire Quaker Oats. Shortly after that, Coca-Cola confirmed that such discussions were indeed in place. But then the market reacted negatively. The share price of Coca-Cola went down 8% on that day and then 2% the next day. And following that, Coca-Cola's board met again and decided to reject the acquisition the following day. Connections were made to the negative market reaction. Okay, so basically, the market reaction that was so negative and probably more negative than they expected led them to rethink the implications of this merger and decide not to pursue it. Not too surprisingly, the next day, Coca-Cola's shares rebounded 8%. Okay, so the market took that as a good development, that they decided to follow the market signal, and as a result, the acquisition was cancelled. Another one, Hewlett-Packard and Compaq, very different circumstances. Also in 2001, there was an announcement that HP is going to acquire Compaq. Following the announcement, HP's stock price falls by 19%. Following that, Walter Hewlett, who is one of the founders and was the president of the Hewlett Foundation, that was a main, a central board member in HP, he announced that he is going to object to this acquisition going forward, even though he supported it before. And basically what he said was the market reaction was so negative that we need to think about that. There were ads in the newspapers saying the market knows best, we should not let it go through, and so on. The market took that opposition as a positive signal, and not going into what happened next, HP stock price rose 17% in response to the fact that Walter Hewlett removed his support. Okay, so you can see here a major decision maker sitting on the board, one of the most influential people in the acquiring firm, basically actively making a decision or changing his view based on the market reaction. Okay, and those are just two examples. Obviously, you know, it is not easy to find many examples like this when managers will say we are following the market. In many cases, the effect will be more subtle. The price will change, they will change their decision, but they will not go up front and say this is because of the market reaction. I think many managers will view that as a sign of weakness. So I think as academics, what we can try to do is to collect data and do large-scale empirical research to try to find patterns in the data that will potentially suggest that this kind of feedback effect exists. And let me review some of the empirical evidence along these lines. There is a very large empirical literature on that. Dong, for example, contributed to it as well, and some other people here. I'm not gonna be able to do justice to all this. I'm just gonna mention a few leading path in trying to identify this kind of connection in the data. Before I do that, it is important to say up front that empirically this is something that is very difficult to identify in the data. Okay, if you just find that stock prices and managerial decisions are positively correlated. Okay, so let's say you say that when the stock price goes up, firms invest more. Clearly, this is very far from establishing evidence for active learning from the market, because very likely both the stock price and the investment decision are affected by something, some piece of information, some development in the fundamental, and we cannot immediately conclude that the managerial decision was affected by the price. Both of them could have been affected by the same underlying factor. So we need to go beyond that and try to tease out from the data whether we can find evidence that would support the idea that there is indeed active learning from the market. So one line of inquiry here has been to basically look at the sensitivity of investment to price and see whether it is stronger in some cases than others. Okay, so you have models of learning from prices, and you have predictions coming out of these models on when learning should be stronger or more prominent. And then basically you can take these predictions and see whether in the data the sensitivity of investment to price is higher in those cases where you expect more learning to happen. Okay, and this has been one line of inquiry. So let me give you some examples here. There is a paper by Luo in 2005 that uses exactly the context that I was mentioning before in my examples, mergers and acquisitions. And he basically shows that mergers are more likely to be canceled when prices react more negatively. Okay, but again, it could be that both the decision and the price respond to the same thing. But then what he shows is that this happens more when a priori we think managers will try to learn. Okay, so for example, he cuts the data into cases where the uncertainty is about technology versus strategic aspects, and he shows that this doesn't happen that much when the uncertainty is about technology. Okay, as I said before, we don't expect managers to learn much from the outside about technology. We expect them to learn more about strategic issues, about market demand, and he shows that those are the cases where the sensitivity of the decision to the market reaction is indeed stronger. He also cuts the data to show that the sensitivity will be stronger when the deal is easier to reverse. So there hasn't been a formal decision, or there is a breakup fee in place, or something along these lines. Okay. Next, so in a paper that I did with Chi Chen and Wei Jiang in 2007, and then in a follow-up paper that by Bakke and Tony Whitehead in 2010, we basically, and all of us show across different papers, that the sensitivity of investment to price is higher when, according to measures of price informativeness from the market microstructure literature, there is more new information in price. Okay, so again, that is something that comes out of a model, and we then confirm it in the data. And importantly, what we show is that you can have measures of managerial information, and you can have measures of new information in prices, and then the sensitivity of investment to price responds to those measures of new information in prices after controlling for measures of managerial information. Okay. Next, papers by Foucault and Fressard also looked at this from different aspects. In one paper, they show that when firms decide to course list, so basically have trading in two markets instead of one, the sensitivity of investment to price increases. Again, you expect that when you have more markets, there will be more to learn from, and then you respond more to market signals. In another paper, they show that firms' investments are also sensitive to the developments in the stock prices of their peers. Okay, so they show that when peers' stock prices are more informative, managers' investment decisions will respond more to stock prices of peers, and also the sensitivity of to their own stock price is going to decrease when their peers' prices are more informative. And finally, in a recent paper by Alex Edmonds and co-author, it is shown that investment sensitivity to price increases following greater enforcement of insider trading laws. The basic idea is when you have more enforcement of insider trading laws, there is more outside information coming into the price instead of insider information coming into the price. And this is when managers could potentially learn more from the price. And again, those are just examples. There are other papers in the literature. But by and large, I think those papers are consistent with the idea that the sensitivity of investment to price is higher in those cases when we expect that there will be learning. So this is indirect evidence pointing to in the connection of learning going on, that it's not just correlation between investment and prices that we see. Okay. Another line of evidence has been proposed around the idea that if there is active effect of the market on decisions, we should expect decisions to be sometimes affected by non-fundamental shocks to prices. Okay? Remember, the concern is we see prices and investments responding to the same thing because both of them are affected by fundamentals. However, if there is indeed active learning and investments respond to prices, then when prices move for non-fundamental reasons, we should expect investment or other real decisions to be affected by this. And there has been a line of papers along these lines, trying to find non-fundamental changes in prices and track the way that they affect real decisions. Okay. So in a paper that I did with Alex Edmonds and Wei Jiang in 2012, we basically use mutual fund extreme outflows as a non-fundamental shock to price and show that firms that are more exposed to this shock are more likely to become takeover targets. Okay? And again, there is a lot of discussion in this paper and in follow-up literature on what exactly this measure captures, to what extent it captures non-fundamental changes. I will say that there is a very clear pattern there that extreme mutual fund outflows cause a decrease in price that reverts back after a year or more, even 2 years. And so that kind of indicates that there is something non-fundamental going on, but this non-fundamental thing does seem to cause some reaction in the real side by making firms more likely to become takeover targets, okay, which obviously causes real changes. In another recent paper, Olivier Dessaint, who is here, and Thierry Foucault, Laurent Fressard, and Adrian Matre, they show that if you use the same non-fundamental shock to price, then firms are going to respond to a negative shock for their peers by cutting their own investment. So you look at the stock price of your peer, you see that it's decreased because of this mutual fund shock, and then you cut your own investment. So again, you learn from something that is non-fundamental. Okay. So overall, the evidence, I think, suggests, I will say at the end, there is room for more evidence, but overall I do think that the evidence suggests that the financial market is not just a sideshow. The information in prices affects managerial decisions. And as a byproduct, noise in prices will also affect managerial decisions. Okay. I will close this part with a quote from Soros from 2009, just after the financial crisis, where he says, up until the crash of 2008, the prevailing view called the efficient market hypothesis was that prices of financial instruments accurately reflect all the available information. But this is not true. We must understand financial markets through a new paradigm which recognizes that they always provide a biased view of the future and that the distortion in prices in financial markets may affect the underlying reality that those prices are supposed to reflect. And he calls this feedback mechanism reflexivity. So does this contradict what I said in the beginning about the information content in prices? In my view, it doesn't. Some people may think it does, but I think both these views fit under the same paradigm, where there is information in prices, there is noise in prices. Decision makers recognize that there is information in prices, and as a result, they sometimes try to learn from it. But occasionally, prices go out of whack, and decision makers don't always know when prices respond to fundamentals versus noise. They continue to respond to it, but sometimes they respond to noise, and this is when noise ends up having a real effect. And that's, I think, a very important paradigm to consider. With a lot of theoretical, conceptual implications. We reviewed some of them in a review paper that I did with Philip Bond and Alex Edmonds that is mentioned up there, and I will come back to it towards the end to highlight some of the potential implications. But again, I think if everyone knew that financial markets just produce noise, no one would care and no one would look at them. People care about financial market prices because they don't produce just noise. They produce some noise and some information. That's why they are important. That's why people react to them. It comes with a blessing that sometimes we get useful information from prices, but it also comes with a downside that occasionally we are going to follow some noise in the market, and these are consistent with each other in my view. And I should say that, you know, Soros has been a very strong proponent of this kind of view, where he says that typically academics who just think that market prices reflect reality and don't affect reality are missing a big part of the picture, and that has been an influence on my thinking. Okay, let me talk briefly about other decision makers or other market prices, just so that you don't go out of here thinking it's only about managers. It's not just about managers, and it's not just about stock prices. So policymakers often learn from market prices. And unlike managers who don't like to admit that they are affected by market prices, I think policymakers say that up front. Here is a quote from Bernanke where he talks about market prices, and he says, policymakers watch financial markets carefully because asset prices and yields are potentially valuable sources of timely information about economic and financial conditions. Because the future returns on most financial assets depend sensitively on economic conditions, asset prices should embody a great deal of investors' collective information and beliefs about the future course of the economy. So he basically calls very clearly for policy to be affected by market prices. I think Bernanke's quote is more about sort of general policy, monetary policy, but it also affects the little details like bank supervision. And this is a quote from Gary Stern, who was a former president of the Minneapolis Fed, where he basically says that bank supervisors should concentrate on finding information in financial markets rather than collecting their own information. Okay, and he says market data are generated by a very large number of participants. Again, that is really the main appeal of market prices, that they are generated by many participants. Market participants have their funds at the risk of loss, and a monetary incentive provides a perspective on risk-taking that is difficult to replicate in a supervisory context. Here comes the incentive. Market participants have the best incentive to provide information because this is how they make money. And so you can trust that the way they trade is probably the way they think. Unlike advisors or consultants who may tell you one thing when they think something else. He goes on to say, you know, you usually base your decisions on accounting measures, but those are backward-looking. Markets are forward-looking. And then finally, the last argument is that raw market prices are free or nearly free to supervisors, which is very important. You know, the information is out there, so it really, it's really difficult to make the argument not to use it, not to look at it, given that it's out there. But there are also other decisions that are based on prices, not just policy decisions. So I mentioned managers before. You know, above the managers, you have the board of directors who decide whether to fire the manager or not. And there is a lot of research showing that the decision to fire a manager to a large extent is related to developments in the stock price. I mentioned here a paper by Genter and Cannon that shows that. Credit ratings, so credit ratings, again, I'm not sure they will fully admit that, but by and large research shows that they are affected by market prices when they decide on a rating, and then the rating goes on to have a real effect because it affects the credit conditions of the firm. You know, there is a recent interesting paper by Gredil, Capadia, and Lee that I mentioned here that suggests that credit rating agencies actually do a fairly good job differentiating fundamental from non-fundamental information. And that is new paper that I think quite interesting. And then you can think about lenders, creditors, depositors who give capital to firms and financial institutions. when they decide whether to give money to a firm, to a bank, whether to deposit, whether to lend, they are also affected by market prices. If you want evidence of this, go back to 2008 and the decision of the SEC and other authorities around the world to basically cut short sales or severely restrict short sales on financial institutions. If you go back and read the way that they explained it, they would say, well, banks, financial institutions are heavily dependent on how the creditors and depositors perceive them, and this is affected by market prices, and that's why they decided to restrict short sales. Okay. Very briefly, I will say, so far I talked mostly about stock prices, but it doesn't have to be only stock prices. It can also be, for example, futures market. I have here another quote from Black from 1976, where he says that one of the key advantages of futures markets is the information that they provide to real production, storage, and so on. This issue has become very relevant recently with the wave of commodity financialization. The fact that commodity futures markets have largely changed and now have many more financial traders, hedge funds, and so on, who trade for various reasons. And many policymakers have been concerned about potential real implications of this, and I've been working on this a bit myself too. I will just mention here a recent Empirical paper that finds intriguing evidence by Brogard, Ringenberg, and Sovich, where they basically say that financialization, they show empirically, and again, one could argue with it, but I will give you the headline. Financialization decreased the informativeness of commodities future prices, and this has led to a decrease in the operating profits of firms that depend on commodities. Okay, so the idea is that the quality of information they get from the futures market decreased, and as a result, they could not make such informed production decisions anymore, and their operating profits decreased. Okay. So I think I only have like 10 minutes left. So let me try to say something about some conceptual insights that this would give you when you think about financial markets and the real economy. And again, I've discussed a bit of my empirical work, but I've done a lot more on the theory side, actually, thinking about this as a new paradigm for financial markets. So let me describe some of the key ideas very briefly. So again, the key implication for theory here is that there is a feedback loop that emerges between market prices and firms' cash flows and fundamentals. Prices both reflect and affect cash flows. That would be the insight that would come out of this premise that there is learning from financial markets. And that is different from the way that theoretical finance has thought about financial markets. Because if you think about traditional models on financial markets and information in financial markets, they don't think about this feedback loop. So we have, models going back to Grossman-Stiglitz, Kyle, Goldstein, Milgram. They all take the financial market to be essentially a sideshow, because what they have is they have some exogenous fundamental of the firm that develops over time, and then you have people in the financial market producing information on this, okay? But you don't have the information that is being produced in the financial market affecting the fundamental. In this traditional paradigm, the fundamental, the investment of the firm, the cash flow of the firm are completely exogenous. Now, the fact that there is a feedback effect would basically suggest that this would be partial, because you basically want to think about a feedback loop where, on the one hand, traders in financial market are producing information about what's going on in the firm, and this affects market prices. But on the other hand, the information that they collect also affects real decisions, okay? So market prices also affect the cash flows. And then there is a feedback loop which potentially changes the equilibrium, the way that financial markets behave, the way that the real economy behaves quite a bit, okay? So in the survey that I mentioned that I did with Philip Bond and Alex Edmonds, we reviewed some of the key ideas here. Let me highlight some of the main ideas. First of all, what we say is, there are two channels for the real effect of financial markets. One is the active learning that I mentioned so far. Another one, which I'm sure many of you are thinking about, is compensation contracts, right? The fact that managers care about financial markets because their compensation depends on stock prices. And as a result, they want to respond to stock prices because it affects their compensation. What we argue in this paper is that both channels are, at the end of the day, actually quite similar. Both of them rely on the informativeness of market prices. Because if you think about why compensation contracts would depend on market prices to begin with, it's only because of the basic premise that there is some information in them. So at the end of the day, those two channels both boil down to price informativeness and the effect that the information in prices has on real decisions. Then we highlight two implications that this kind of feedback loop will have for the theoretical research and for the paradigm that we should use for thinking about financial markets and their connection with the real economy. One is that incorporating the feedback effect into models of trading in financial markets very fundamentally changes the way that the financial market works in these models, okay? So it's not just you add feedback and everything stays the same. What we find in many of these papers is you add feedback from the financial market to real decisions, and this changes the way that people behave in the financial market to begin with, okay? And I will try to give a couple of examples on this just before I conclude. The second general lesson that we draw is that there are really different notions of efficiency, and we think that the literature has focused on the wrong one. So you can think about forecasting price efficiency, which is basically the ability of market prices to forecast future values, future realizations of firm cash flows and profits and so on. And you can think about revelatory price efficiency, which is the ability of financial markets to produce the information that will guide real decisions. Those are the names we give them, but you can map those to market efficiency and real efficiency. So the forecasting price efficiency is really what has been studied in finance all along, which is the notion of market efficiency. How good are markets at predicting the future? And then the second one is real efficiency, which is the ability of markets to provide information that will improve the efficiency of real investment decisions, okay? And we argue that the real efficiency is what really matters, but we think that the literature has mostly focused on market efficiency. And we think that more work should be done to understand implications of financial markets for real efficiency. Okay, so I'm close to running out of time. I have a bunch of examples for new conceptual insights that one could get out of this paradigm for understanding how financial markets work. Let me maybe just mention one of them here in a paper that I had with Alex Edmonds and Wei Jiang in 2015, which is about asymmetric trading and limits to arbitrage and how this is generated by the feedback effect from financial markets to the real economy. So in general, we think about limit to arbitrage as a situation where trading on private information is going to have frictions. People are not going to trade on private information as much as they would like to. Okay, so there is some friction that prevents them from doing that. And there is an endogenous friction here that emerges because of the feedback effect. Think about the following situation. People out there in the financial market think that managers are about to make a very big mistake, okay, like an acquisition. People in the financial market think the acquisition is a bad idea. So normally they would start selling the firm, right? start selling the stock to convey the fact that they think the firm is about to make a big mistake. However, once you take into account the feedback effect, if managers or directors or someone in the real economy is learning from it and potentially will correct the decision following the change in market prices, then eventually the bad decision would not happen, and investors could not really make a profit by trading negatively on what they think is a bad thing that the firm is about to do. Go back to this Quaker Oats Coca-Cola example that I gave you. There were people out there thinking this is a terrible acquisition, started selling, hoping to make a profit, but then, unfortunately for them, the firm canceled the acquisition, and then there is no profit to be made. Okay, so what we argue is negative information is not going to flow very well into financial markets because of this channel. Speculators that understand that negative information would lead to correction will hold on and not trade, and then negative information is not going to flow into financial markets as smoothly. The same is not true for positive information. If you think the firm is doing a great thing, you will buy. The firm will look at that as a signal, do more of this great thing, and then you can make a profit on the fact that you bought. So there is an asymmetry between negative and positive arbitrage, suggesting that negative information might flow too slowly or not at all, given this tendency for feedback and correcting bad decisions following market feedback. I'll skip the rest. There are some other implications. Let me briefly just conclude. So I think feedback effects are a natural consequence of informative markets. It's hard to ignore the fact that at the end of the day, managers and other decision makers are human beings. They're looking for all sources of information they can find. And if they see the market reacting in a certain way, it will affect the way that they behave. They involve different decision makers, different markets. I think there is evidence for it, and I think that by and large, what we should think about is also the theoretical implication, the way it changes the paradigm via which we think about financial markets. And I think there are many opportunities for future research, both on the empirical and theoretical side. So this is still very much work in progress. Thank you.